In the next 10 minutes, I'm going to walk you through something most financial advisors won't tell you. That $300,000 mortgage you locked in at what felt like a reasonable payment. It just became significantly heavier. And the wage collapse that's about to hit your household will make it feel nearly unbearable. Here's what I'm showing you today. The exact Bureau of Labor Statistics employment data that flagged wage lags 18 months before the 2008 job bloodbath. The Census Bureau retail inventory numbers confirming the identical pattern is starting right now in real time. What's really happening to a $150,000 household carrying $300,000 in fixed debt? And most importantly, the one stress test you absolutely must run this week before employment shocks ripple through your income. Let's start with the hardest truth. The traditional belief that deflation, falling prices, helps borrowers because you'll have more purchasing power. That's completely backwards, and I'm going to show you exactly why that kills household cash flow in deflationary cycles, and why it's about to matter a lot more than most people realize. Part 1. The wrong belief that kills your cash flow ***. When most people hear the word deflation, they think about lower prices at the grocery store. Milk costs $3 instead of $4. Gas drops from $4 a gallon to $2.80. On the surface, that sounds great for a household budget. The prevailing narrative, repeated by mainstream financial media, is that deflation automatically improves the financial position of borrowers. You owe $300,000 on your mortgage, the logic goes. If deflation hits and prices fall 5%, then in real terms, your debt burden shrinks because you're paying it back with money that's worth more. This sounds right. It's intuitive. It's also a trap that destroys household finances. Here's why. When deflation hits, wages don't just stay flat, they collapse. And they collapse faster than prices fall. This creates a vicious cycle that we can see clearly in the data from 2007-2009. Let's look at what actually happened. According to BLS data analyzed by the Federal Reserve Bank of New York, real wage growth, wages adjusted for inflation, started declining in Q3 2006. A full 18 months before the financial crisis peaked in September 2008. This wasn't a small decline. In certain sectors, construction, retail, hospitality, nominal wage growth turned negative by Q2 2007. Construction workers who earned $22 an hour in 2006 were earning $21.50 by early 2008. Retail workers saw hours cut before base pay declined, compressing monthly income by 8-12% even before the crisis officially started. But here's the crucial part. During this same period, housing prices hadn't collapsed yet. Mortgages remained fixed at the 2006-2007 rates. So a household in Denver or Phoenix in early 2008 had a $300,000 mortgage payment that was locked in, but their income had already dropped 5-10%. That ratio, fixed debt payments rising relative to declining income, is what creates the liquidity crisis. This is the opposite of what the deflation helps borrowers narrative predicts. The deflation comes after the wage shock, not before it. And when it arrives, it locks in the damage. Part 2. The 2008 warning signal that's flashing again right now. Let's get specific about how this signal appears in the data. The key metric is called the wage-to-employment ratio shock. Here's what it measures. In normal economic periods when unemployment rises 1%, average wages typically fall 5%, accounting for compositional effects, lower wage workers leaving the workforce. But in the months before major employment collapses, you see something different. Wage growth stalls or turns negative while unemployment is still low. In 2006-2007 we saw exactly this pattern. Q4 2006 unemployment at 4%. Real wage growth plus 0.8%. Normal Q2 2007 unemployment at 5%. Real wage growth minus 0.3%. Warning sign Q4 2007 unemployment at 25%. Real wage growth minus 1.2%. Critical Q2 2008 unemployment at 5%. Real wage growth minus 1% crisis. Notice the pattern. Wages started deteriorating while unemployment was still near historic lows This is the signal that employment is about to collapse, not the signal that it already has. Now look at what's happening right now in 2024 Q2 2024 unemployment at 39%. Real wage growth plus 0.4%. Slowing Q3 2024 unemployment at 2%. Real wage growth minus 0.1%. Turning negative Q4 2024 unemployment at 3%. Real wage growth minus 0.6%. Accelerating decline. The Census Bureau's retail inventory data adds another confirmation. When employment is about to contract, retailers stop restocking aggressively. They sense demand is weakening. Census data from December 2024 shows retail inventory at 35 months of sales. That's exactly where it was in Q2 2008, 3 months before the financial collapse accelerated. What does this mean for a typical household? Let's model it. Part 3. The real dollar impact on a $150K household with $300K debt Let's create a real household scenario. This is based on median household income data and census mortgage statistics. Starting position, Q4 2024. Household income, $150,000 combined 2 earners mortgage, $300,006. 5% rate locked in 2023-2024 monthly mortgage payment, $1, 896 other fixed debt, $400/month car loans, student loans total monthly debt service, $2, 296 debt service ratio, 18, 4% of gross income sustainable range, under 28% this household feels fine, the ratio is healthy, the mortgage seems manageable. Now let's apply what happened in 2008. A typical household in a discretionary sector, retail, hospitality, light manufacturing, experienced, primary earner hours cut 15-20%. Income drops from $95,000 to $76,000, $81,000, $000 secondary earner hours cut 10-15%. Income drops from $55,000 to $47,000, $49,000, $000 total household income drops to approximately $125,000, a 16.7% decline, but the mortgage payment, still $1, 896, still $400 for other debt. Now that same household looks like this. After 16.7% income shock. Household income. $125,000 monthly debt service. $2, 296 debt service ratio. 22. 1% of gross income now stretched thin monthly cash flow impact. $2, 0.83 worse per month. The difference between what they earned and what they owe. This is where the deflation trap actually kills you. If prices fall 3-5%, which they did in 2008-2009, that helps with groceries and gas. But it doesn't help with your $1, 896 mortgage. That payment is fixed. You owe the exact same dollars as before, except now you're earning 16.7% less. Consider this real case study. In 2008, a Phoenix family with similar numbers took a 15% income hit, husband in construction, wife in retail. Their $300,000 mortgage didn't budge. They tried to refinance, but by mid-2008, housing values had already dropped 12%, so they were underwater and couldn't refinance. By early 2009, they'd exhausted their savings and had to short sell the home, taking a $45,000 loss. That household didn't fail because they were reckless. They failed because the wage shock came first, prices came later, and fixed debt payments stayed the same throughout. Part 4. The deflation math that contradicts conventional wisdom. Let's break down why deflation actually hurts borrowers in a wage collapse environment. Assume 5% deflation hits between Q1 and Q4 2025. Nominal terms. Your $1, 896 mortgage payment is still $1, 896 your $125, 000 salary is still $125, 000 debt service ratio, still 22. 1%. Real terms adjusted for 5% deflation. Your mortgage payment in today's dollars. $1, 991. It takes more effort to earn the real value of money needed to pay it, your salary in today's dollars. $131, 250 seems good. But here's the trap. The first effect hits immediately. Your paycheck shrinks in nominal terms before you see the benefit of deflation in prices. This happens over weeks and months. The benefit of lower prices takes quarters or years to fully materialize, and only if you're actually buying those deflating goods. For a household already struggling with a 16% income shock, that timing gap is fatal. You don't have months to wait for deflation to reduce your grocery costs. Your mortgage is due on the 1st of every month. Your car payment is due on the 15th. You need cash flow now. This is what happened across the U.S. In 2008-2009, wages collapsed first, Q3 2007, Q2 2009. Deflation arrived later, Q4 2008, Q2 2009. By the time prices fell, millions of households were already 3-6 months behind on mortgage payments. The data confirms this. According to the Federal Reserve, delinquency rates on mortgages hit 6.1% by Q1 2010, not because deflation occurred, but because the wage shock had already hit before deflation could provide any relief. Part 5. The stress test every household must run this week. Here's the actionable part. Before the employment shocks hit, you need to know whether your household can survive a wage reduction scenario. This takes 15 minutes. Step 1. Calculate your current debt service ratio. Add up all monthly debt payments, mortgage, car loans, student loans, credit cards, personal loans. Divide by your gross monthly household income. If it's above 28%, you're already in danger. Above 35%, you're vulnerable to any income shock. Step 2. Model a 3%, 5%, and 10% household income reduction. 3% might happen if you lose 5-10 hours per week at your job. Minus 5% might happen if one earner's hours are cut 15%. 10% is worst case. One earner loses 30% of hours, or one earner loses the job. Temporarily recalculate your debt service ratio at each level. Step 3. Identify your liquidity cushion. How many months of debt payments do you have saved in emergency funds? Financial advisors typically recommend 3-6 months in a wage shock environment. Next 12-18 months. Aim for 6-9 months if your income is discretionary sector dependent. Step 4. Identify which debts are truly fixed. Your mortgage. Fixed, you can't renegotiate easily. Your auto loan. Usually fixed your credit card payments. Variable, you can reduce these temporarily. Though it damages your credit, understand which debts are flexible if cash flow tightens. Step 5. Create a wage reduction action plan. If your income drops 5%, what expenses get cut first? Can you refinance any variable rate debt to lower the payment? Could you sell a second car, downsize housing, or take other major actions? Have this plan written out before the crisis hits. The benchmark. If your debt service ratio is currently 20% or below you have 6 months of emergency savings and less than 70% of your income. Depends on discretionary sector employment. You can likely weather a 5-10% wage shock without catastrophic financial damage. If any of those 3 conditions fail, you need to take action now. Either reduce debt before the wage shock hits, increase your emergency savings, or both. Conclusion. The timeline if the 2008 pattern repeats, here's what the next 18 months looks like. Month 0-3, now March 2025. Wage growth turns negative in discretionary sectors. Most households don't notice yet because unemployment is still low. Early warning signs are visible in BLS data, but mainstream media hasn't caught on. Month 3-9, April-September 2025. Employment starts contracting. Hours get cut before jobs are eliminated. Retail and hospitality hit first. Household income starts dropping noticeably. This is the shock phase where fixed debt payments suddenly feel heavy. Month 9-15, October 2025, April 2026. Deflationary pressures intensify. Some prices fall, but it's too late for households already in liquidity crises. Delinquencies spike. Foreclosures begin accelerating. Months 15-18, May-August 2026. The adjustment completes. Most damage is done to those who didn't prepare. Those who stress tested, reduced debt, and built liquidity cushions absorb the shock without